Micheal Burry just pulled the most shocking move he has done since his move prior to the great financial crisis. Yes, the man who definitely got famous from the movie The Big Short, right? Micheal Burry loaded up on bearish options in the second quarter filing shows. I want to take you through what Burry's up to here, okay? This is a startling, insane, like bet your reputation, your career type move he's making here, okay? This is no small little nothing move. This is monumental and massive, okay? I want to show you what's going on here. I want to give you my perspective and opinion on what he's up to here and kind of my thoughts if I like this move, if I don't like this move, if I think there was something better he could have done in my personal opinion and all those sorts of things. So I appreciate you guys being here. Thanks for being subscribed, folks. Wow, this is crazy, okay? I appreciate y'all being here as always, okay? Micheal Burry, the trader who rose to fame with his winning bets during the subprime crisis, which were obviously featured in the book and the movie The Big Short, loaded up during the second quarter on put options, which put options, just simply put, is basically a bet that certain stocks or an index are going to go down by a certain date, okay? That would pay off if the S&P 500 and NASDAQ sank, a regulatory filing shows on Monday. The filing drew attention on social media, though such data is dated, because do remember this in terms of this filing, it was as of June 30th. Obviously, as of today, it's August, 14th today, right? So he could have completely moved out of this position. Highly unlikely, but it's a possibility. So do keep that in mind, okay? The 13F filing shows that Scion held 2 million put option contracts. We're not talking about $2 million worth of put option contracts. We're talking about 2 million put option contracts on the Spider S&P 500 ETF Trust SPY, which tracks S&P 500 as of June 30th. It also had held 2 million puts on the popular Invesco QQQ, which obviously the QQQs have been flying high this year, right? This is a shockingly startling move, okay? Put options give the holder the right, but not the obligation to sell the underlying asset by a set time for a set price, known as the strike price, and are thus popular instruments for betting on downturns, right? So he could keep these all the way till expiration, which we'll speak about expiration in just a moment. But the thing you got to understand, I think this is very important that everybody watching this understands this, okay, is Burry can, if he chooses to do so, sell these option contracts off to somebody else in the future. So let's just say hypothetically, these option contracts expire, let's say a year from now. But let's say the stock market tanks for whatever reason over the next 6 months. 6 months down the road, if he wants, 7 months, 8 months, whatever, he can sell these off to somebody else. So he doesn't have to exercise these all the way up until the date. And I think that's just something that's important that everybody understands about kind of options and how these things work, okay? But they can also be used as a hedge positions or part of a broader strategy. The SPY puts made up more than 51% of Scion's reported holdings, according to whalewisdom.com, while the QQQ puts accounted for more than 42% as of June 30th. This is like a, put the chips on the table and shove them in type move by Micheal Burry here, okay? That's why I say this is a no-jokers, holy smokers move, okay? But investors are required to disclose only long positions held at the end of the quarter. So filings may not offer a complete picture, right? I went to that Whale Wisdom website, I think it was called Whale Wisdom, Whale Wisdom, and I went ahead and looked this up, and I'm like, it's a startling move in regards to Burry here. This is like, he's betting like the future of Scion really on these puts. Like this is intense, man. I think this is as epic of a move, right, as the move he made prior to the great financial crisis in terms of just like betting your reputation, betting your fun, betting your mental sanity on these put options. Like this is intense and insane. I'm like, this is crazy, okay? No other details were immediately known, such as the strike price. I'll tell you what I think the strike price was in just a moment and those sorts of things, okay? The date it expires, a premium paid, or current holding status with regards to these put option contracts. However, the total contract value of $1.6 billion represents about 93% of Micheal Burry's reported portfolio. Put option holders usually gain when the price of an underlying security falls, right? So as simply put as possible, he's basically betting that the S&P 500 is going to fall significantly likely, and the Qs are going to drop significantly, the NASDAQ 100, right? Which you know, if you're going to make a bet like this, you've got to be very convinced that these indexes are going to fall at least probably like 20% plus. Like, you're not going to make a bet like this if you think there's a 5 to 10% pullback. It's not worth it. You've got to be convinced that there's a massive move down coming for these, right? The Spider S&P 500 ETF Trust was trading at $443 a share on June 30th, 2023, whereas AQs were trading at about $369, and basically they're around flattish since this reporting date. Now, we also don't know. He could have been loading up on these short positions in April, May. It could have been June, right? So we don't know exactly when he put these on. Now, my personal opinion in regards to what I think he did strike price wise here, or not strike price wise, but in terms of how far out expiration wise, okay? And I have no inside knowledge of this, but in my personal opinion, he likely bought these to expire at the beginning of 2024 or maybe the middle of 2024, based upon the fact that he put these on in the second quarter of this year, obviously. He wants to buy himself some time. So I'm thinking the beginning of 2024, maybe middle of 2024 in terms of expiration for these, in my personal opinion. Now, he could have done shorter. Maybe he did them to expire at some point this fall in 2023. I don't know if he would make that big of a bet in that short of a time frame, because you need things to play out here a while, right? And to put yourself under the gun like that, especially when you're this heavy into the position, is very, very risky, okay? Because sometimes it takes the market a little while to deteriorate, you know, and it takes longer than you think, right? A friend sent me this little kind of meme here, okay? They don't know how short I am, right? Micheal Burry has now put 93% of his entire portfolio into the SPY and QQQ puts, like, and people are talking about melt up, we resume the melt up? And that's the risk, man. Because if this goes bad, it's going to be devastating to, obviously, Scion Capital Management. Like, my gosh, right? Now, next thing I think is interesting about this is he's betting against S&P 500. He's betting against the Qs, right? He could have taken an approach of betting against big tech, right? He could have bet against stocks like Adobe or Intuit or NVIDIA or some of these stocks, but he'd rather just bet against, you know, kind of more ETFs, indexes in general, which is very intriguing. And it takes away some of the risk. It mitigates some of the risk of, like, you know, let's say you bet against NVIDIA. But let's say NVIDIA just, regardless of recession, no recession, anything like that, let's say NVIDIA just keeps putting up sick numbers, quarter after quarter after quarter. Well, then the stock price damage would be limited. So you could get a scenario where if you just bet against one or two stocks and those stocks do good, meanwhile, the rest of the stocks are doing crap, like, you know, you're in a bad situation. So some investors are now taking the approach that instead of betting against one or two stocks, they'd rather bet against indexes in general, especially knowing that they're going to make waves. Like, when it's announced, like, Micheal Burry's ... right? Everybody's going to look, right? And if, you know, let's say he had bet huge against a home builder, for instance. Let's say, well, then people know, okay, Burry's super heavy short this stock or got all these put options. At some point in time, maybe we can cause some sort of gamma squeeze here. Like, you can have all those games of Wall Street played when it's against an entire ETF, an entire index, whatever. That makes it a lot tougher to play those sorts of games against it. Much, much tougher, okay? Now, here's why this could be a problem for Burry, okay? And a pretty significant problem. Because he needs things to deteriorate rather quickly, okay? Let's say you think he bought these puts all the way at the end of 2024. Well, regardless, he really needs the market to deteriorate in a massive way over the next 12 to 18 months. Because remember, he had to pay a premium to get these options. Now, the further out you go, the more premium you're going to have to pay for these options. So keep in mind, he's going to need the market to deteriorate in a pretty epic way quickly to really make a lot of money. And when I say quickly, I mean really over the next 6 to 12 months, right? And here's a few issues he has to work with, okay? And these are significant issues. One is consumer sentiment hit the lowest it ever hit in 2022. Now, we have started to come back in terms of consumer sentiment, right? Now, we're still in really low. Like, usually when you're in a really good economy, a truly good economy, you're around 100, okay, in terms of consumer sentiment. You know, right now we're still not even in a good place. But let's say hypothetically consumer sentiment continues to improve for the next many months. That could delay some sort of recessionary scenario, some big boom, right? That's a risk factor that Burry has to take into account here that I think is a pretty significant one when you already hit the lowest consumer sentiment we've seen in history, right? The next thing I think he should take into account before making a bet like this is real wages. Real wages have been in a bad place for years. finally real wages are starting to get in a better place. Real wages are wages adjusted for inflation, or equivalently, wages in terms of amounts of goods and services that can be bought, right? Finally, obviously, inflation is becoming less of an issue. It's still somewhat of an issue, but it's obviously way less of an issue than it was a year ago, 2 years ago. And real wages in terms of wages, have continued to go up. So finally, we're getting real wages into a healthier place. So that's something that I think is a risk factor in terms of delaying some sort of problem, right? The next thing up is student loans. Now, that's going to hit the economy, but that could be more toward a 2024 situation there. And I've even heard there's some stuff in regards to student loans where, a lot of individuals might not pay back those student loans because the government won't count it against their credit scores and things like that for the first 12 months. So I think in terms of student loans, I think it can hit, but I think that's more of a 2024 hit rather than a 2023 hit, right? People are expecting this to negatively affect things in a dramatic way in 2023, and I'm just like, it could affect things, but it could be more in 2024, okay? So that's something to take into account here in a pretty significant way, okay? Next thing up here, right, is the Fed lags, right? The Fed lags are due to catch up, right? They're due to catch up. Fed lags are basically, after the Fed starts raising rates, how long does it take for it to really hit the economy in a significant way, right? Now, in terms of Fed lags, they're likely going to hit in either 2024 or 2025. But the issue is, right, if Burry's got these options, let's say they expire at the end of this year, or let's say they expire at the beginning of 2024, let's say they expire in the middle of 2024, he needs the Fed lags to really come on, kick in soon, okay, baby, because you're running out of time here, right? But you got to understand, from the time the Fed starts raising interest rates, it's a 1 to 3 year Fed lag cycle usually. 1 to 3 years from what I've seen throughout history, looking back throughout history. Okay, 1 to 3 years before it really hits the market in a huge way, and it really hits the economy in a huge way, which is what matters more, right? 1 to 3 years. So the Fed started raising rates, obviously, March of 2022. So we're in kind of like the 18 months into the cycle, roughly, somewhere in there right now, right? So likely it's going to hit probably 2024, but it could wait all the way until 2025. And so if Burry's options are expiring anytime soon, he might not have been able to capture the Fed lags, right? And you say, well, if he was placing some sort of options for 2025, why place him now? Yeah, that does make a lot of sense. You'd wait till 2024 at some point to place those. So likely his expiration dates are at some point in 2024, likely, right? So that's something to keep in mind. Now, next point, and this is so important, I mentioned this, okay? Extremely important. If you have ever seen the movie The Big Short, okay, something you know about is Burry placed his bets early, and he was wrong for actually a couple years, and his investors gave him hell. They're saying, what are you doing? We're losing money. The housing market just keeps getting better. The economy looks strong, like all this stuff. And so do keep in mind, Burry's been wrong about timing before, right? Now, you can say maybe this time he's going to get it closer to being right. That's a potential. But he's been wrong before, okay? And he was wrong for several years. And his investors were not happy with that man. They're like, we can't believe you are placing these sorts of bets that were seen as crazy at that time, which, you could make an argument that these are pretty wild in terms of the level of the weighting of these sorts of bets, right? And what if he's early here? What if we don't see it until 2025? What if we don't see a major recession until 2026? You never know how that's going to play out, right? So I think that matters in a significant way as well, right? He's been early before. Maybe he's a year, 2 years, 3 years early again, right, in regards to this, right? Now, my personal opinion on this, okay, is I don't love the move, okay? I certainly don't love the move from Burry. He's betting so heavy that this market's going to tank. I don't love the move. I like hedging instead, okay? Why do you have to force so much of your fund's capital? Yeah, if this goes right and the market tanks, you're going to make a fortune and you're going to be seen as a hero, okay? But there's always a potential you're wrong. There's always a potential the Fed pivots, bails out the market. We know the Fed is now in a mental space of bailing out the market time and time again. They keep doing it again and again and again, right? Once they see the economy get hit. And so once unemployment starts to tick up at all, you know they're going to cut rates low. which is going to force people that are in treasuries or in CD accounts, savings accounts, things like that to consider, okay, where do I put my money now that I can't make any money? And if stocks are going lower at that time, you could put somewhat of a floor into the market. It's not a total floor, but somewhat of a floor, because people are going to say, well, the stocks are getting cheaper, much cheaper, and I can't get anything from my CD accounts, savings accounts, treasuries at that time. Then you go ahead and funnel in money, right? So I don't love the move. I think it's highly risky. I'd much rather hedge. I'm hedging right now, right? And so if the market does drop in 2024 in a significant way, I want to make a bunch of money from that, from my hedges, right? But I'm not going to risk betting my whole portfolio on that being the situation, because it could be 2025, things get ugly. Maybe it doesn't even happen. We don't know, okay? And so to bet so heavy, I think it's a very, very, very dangerous move. Now, this next chart is so important, okay? This is so important. What you're looking at here is money market funds in total assets, okay? We've skyrocketed this number over the last number of years. Basically, around 2018, this number started skyrocketing in a major way, and specifically, it made a kind of a boom move during Rona, and it made another boom move here recently, okay? Now, you might think, and I was talking to the private group about this today, okay? We talked about a whole different bunch of macroeconomic subjects here today, okay? And this was just one of those subjects I spoke about to the private group here today, okay? Now, there's a couple ways of looking at this, right? One is, okay, if the market tanks, this money's going to find its way back into the stock market. Now, another way to look at that is, well, look at what happened prior to the great financial crisis. We had a skyrocketing money market funds prior to the great financial crisis. Now, did that save the stock market? Absolutely not. The indexes still fell 50% plus, even with a skyrocketing money market funds prior to the great financial crisis. And it actually peaked out right around the same time that essentially the Federal Reserve obviously decided to do their quantitative easing, and the market bottomed and all those sorts of things, okay, which was kind of early '09, which is fascinating to see. So the bottom line with this is you can look at it both ways. One is there's a lot of money on the sideline that's waiting to come in this market at some point in time, which could push out a stock market crash scenario. But the other side is, well, we've seen money market funds climb before, and that didn't save the market before. And that's what makes it a very confusing time. And so I think it's a very dangerous time to be either all in the market from the long side or all in the market super heavy from the short side as well. Because there's so many, this is no clear cut, it's going to be this way or that way. And especially in terms of timing. And when you're talking about put options, you need your timing to be perfect, okay? So I'd much rather just hedge and play that game. You can hedge also with cash. You can buy some puts on some stocks here and there, some indexes here and there, but you can also hedge by putting some cash on the sideline and making 4 or 5% guaranteed right now while the show plays on, okay? There's a lot of options out there. And also there's some great opportunities from the long side as well. It's a beautiful market, okay? I appreciate everybody joining me as always. Love to hear your guys' opinion and perspective as always. I put together a very nice free workshop for you guys. I put one together if you make less than $100,000 a year investing in 2023 and beyond. And I put together one for you guys that make over $100,000 a year. If you want free access to that, check out the pinned comment down there, okay? Much love and have a great day.